feels like it's been forever since I've talked to Brett Manning. For whatever reason, over the course of the last couple of weeks, we've been missing each other. Either I've been out or he's been out, but can't say that anymore because it's time to bring in the man himself, Brett Manning, a.k.a. Chart Trader. What's up, Brett?
Hey, Jim. How you doing?
I'm doing all right. So Gavin may be joining us as well, so just
oh, great.
Yeah, quick invite for him if he's willing and has anything to ask. But yeah, just heads up to you.
Sounds good.
All right, so we've got a few things to go over, and I wanted to start with, I guess, your note yesterday, which you highlighted some of the activity that you observed in the commitment of traders, that being the CFTC data that we talk about from time to time. And just for the listeners out there, I'm gonna try to show the charts that I can, and I'm getting them from barchart.com, and they have a commitment of traders link that you can follow along. Is that's what you use, right, Brett?
Yeah, that's one of the services I use. I like the fact that they lay out a visual record, so you're comparing the current situation with past data.
Okay.
So it puts it in context.
Okay. And so since you do follow along on the visual as well, if I have the wrong chart up, just let me know and I'll try to adjust it. But why don't we start with gold, because you found something very interesting in that, and since it's relevant because you have a gold futures position on and you have a position on in dust, let's start there because I think it's a very unique situation as you highlighted.
Yep. Sure. This goes back to my chart book that I posted, I think, last week, that covered the basic kind of scenario of gold over the long term, where commitment of traders data is concerned. You really, really rarely have a net short on the speculator side, and I think one of the ways to understand why that is, that's not because people are rarely bearish on gold. A futures market is a zero-sum alignment. You have to have somebody on both sides of any contract, right? If somebody's long a contract, that means somebody else has to be short the contract, right? So every contract is defined by, a kind of, if you think in physics terms, of like an electron and a positron or something. And you have to have that balance. So with gold is not perishable. And the storage cost for gold can be relatively low, and the amount of gold that exists in the world is a finite thing, and whether it's in the ground or above ground, it doesn't get consumed. If you turn it into a necklace, it's still supply, in theory, in the gold market. So gold is kind of unique that way. And, if you own a gold mine, you own the gold that's underground, and you do prospecting to figure out how much gold that is. You get a pretty decent sense. It's never exact, but you're never super far off. You have a pretty good idea of how much gold you own. So for a gold miner, that's your long position, is the gold that's in the ground. So the producers are always going to be short the futures because they're selling their long position in the futures market, right? So there's always going to be everybody who owns the gold is always going to be short in the futures market. So anybody who wants to speculate, who's going to buy it from you if you want a short? The speculators are the long side of that market. The producers are the short side of that market. It's just the math of how the futures market is constructed. It's very, very difficult to end up with a speculative net short position just based on the mechanics of the supply of contracts in the net interest for gold futures. So it's really, really rare, and only at the very deepest, darkest periods for gold do we ever really see that. And we flicked down to basically flat net interest for speculators in the sort of crash that we saw a few years ago. That was really the downward thrust of the bear market. And there was a touch of it in mid-2013, and there was a touch of it in October, November 2014. And I was actually short that market in 2014 into a big crash that we saw then that I covered on the establishment of very close to net short positioning. That was kind of one of the signals I was looking for. Before that, so we didn't quite get net short then. Before that, you really have to go back to 2002. And so there's this period from 98 to 2002 where gold had been so cast overboard. The central banks were getting rid of it. It was just, we'd gone through such a protracted period of disinflationary, strong economic growth and, a very low geopolitical issues until we got to 9/11. That had been a period that kind of like a golden age in a lot of ways, and with the technology revolution and everything going on. All of that was disinflationary and strong and stable. And gold just got thrown overboard. And that's really the last time that we saw any kind of net short position established in gold. And so since then, it's always been net long until just a few days ago. It was the first time that we'd seen gold futures go net short. And I think that this is part of a larger kind of complex of ideas that are becoming extremely popular right now because it matches a new burst to, by far and away, the biggest short position in the 10-year T-note futures. And I know maybe you want to go through these things individually, but I kind of just want to preview the idea that this is part of a larger idea. It's not just about gold. It's a big burst of dollar net long, a big burst of bets saying U.S. interest rates are going higher, and a big burst of gold net short. And that all highlights a theme of everybody kind of coming to a consensus bet on an extended period of disinflationary growth in the U.S. paired with continued sluggishness when you look at other big economic systems such as Europe, Japan, and China. And a lot of that has to do with whether or not the cycles are synchronized. They're not. And then also the trade war where the U.S. is actively undermining things like Chinese growth. So hopefully that all makes sense in how it all fits together.
Yes, it does. To look at it graphically, though, am I looking at the right chart now on the visual for everybody?
Yeah, it looks like it to me.
Okay. And so the different lines, you've got this one that has the... Let's see, so we got two of them, and one of them looks like maybe a continuous chart, and then one that isn't continuous.
Okay, so the top one, the bottom one, let me tell you, the bottom one is subsumed within the top one. So they just started breaking it down more, starting in, 2007 or so. Mm-hmm. But the top one is the same data. It's just they're taking the speculators and they're breaking them into like money managers and hedge funds and stuff.
Okay, got it.
But it is part of the top chart's data. The top chart is all the data, and then they just further broke down the classification standards to provide more information starting about a decade ago.
Okay, and so when I'm looking at this chart and you say it's net short, where do I see that net short position? Gotcha.
So the red line is the producers, basically. If you're looking for commercial speculators in gold, mm-hmm. You're pretty much talking the gold miners. So they have trading. They need to be, holding that short because what they're doing is strategically selling gold that's in the ground as, you could think of it as a hedge, but really it's like forward sales.
Okay.
And the green line on the top is the large speculators. There's a blue line in the middle that's small speculators that's really inconsequential as a part of this market. So you'll see, though, that it all adds up to zero. The red line on a negative number adds up pretty much to the blue line plus the green line, wherever they are. So, and again, it's because you have to have a net zero sum in a futures market. The green line, though, is the one that I'm talking about. So when you see that it just dove down to touch the 0 point mm-hmm. just now, right? So the previous times over the last 10 years or so, you can see one in 2013 and one in late 2014. And it looks touch in late 2015 as well. So there's little touches down there, but they don't quite get negative. Right, it gets really close to negative. It gets under 25,000 net long contracts, but never gets net negative until just last Friday. That's the first time that we've seen it. Since if you go all the way back to, I think, 2002, you'll see the last time that it was really under the zero line.
Okay, so the large spec number, the minus 3688, is what I'm looking at, right?
Yeah.
Perfect.
Yeah, right. I mean, is it minus 36? I don't see that on the chart, but either way.
That's what it says on mine, but yeah.
Okay, yeah, that's that. Right. So a couple thousand short net. So you're looking at anybody who's registered as a large speculator If you add all of those positions up, so each one of them has to report when they have a certain amount of size in the market. They have to report to the CFTC. All of it comes from those reports. So the people who are the commercial traders, they work for mostly gold miners, are reporting their positions, and the people who are speculating on a big basis, if you think of like commodity hedge funds and large traders, when they get to a certain size, they have to report to the CFTC because they have that much of a share of the market. So when you add up all the people that are classified as speculators, it now comes to a slightly negative number as a total. And that is the first time since about 2002.
Okay, perfect. All right. Hopefully that makes sense to the listeners. I'm caught up. I know what you're talking about. And if you do have any further questions, I can do some follow-up with the listeners later on. So let's move on. As far as how you put together that gold position. Now, I was watching it pretty intently and noticed that you were almost stopped out, but not quite. And you had highlighted that. Yeah, that was real close. Were you sweating?
What did I say? You remember? I said when it gets under 1180, when it gets under 1180, something crazy could happen, and I wanted to give it lots of room because I know there could be a little puke there, and we got a bigger puke than I thought, and it got within I think a half point of my stop.
Yeah, it got close.
And, yeah, right, and that's how the universe works. It's like with trading, there's always those moments where you ever been in those trades where you get ticked out, right? It turns out to a great trade, but you don't get in it because it just slashed back and barely touched your stop by a penny, took you out, and then went where you wanted it to go. Like everybody has that story. And you have to remember, and one of the things I tell people when they kind of report to me this, they send me a Skype or something saying, oh man, look at this chart. Can you believe I was stopped out at such and such? And, I always say, you got to remember there are moments like this trade, right? I try to bring up an idea like this trade that you saw with gold here, where there are plenty of times, if you think about it, where it gets within, a small amount of your stop and doesn't stop you out. And it's kind of like those are the lucky moments, right? You've got the unlucky moments and the lucky moments, and they balance out pretty well. And this is, I got lucky that there wasn't a big stop right above mine that flushed and triggered and just took it that extra half point because I wasn't watching it at that moment. So.
Well, good for you because you might have been sweating it. You might not have slept if you might have been.
Right.
You probably would have been excited that it didn't get hit.
Yeah.
Who knows?
Oh no, right. Yeah, and I may have added to it. That would have been the one thing that could have positive come from it. But who knows? It's a counterfactual reality. Either way, the point is, I knew that I had to give it a lot of room, and it looks like by luck and randomness, I happened to give it just enough room, and now it's come back most of the way back to break even, and it's acting better. And I added the dust position last week late as a dust short, which was my way of adding to this position in a way that I felt was actually more dependable to not be wrong, rather than necessarily something that would benefit me the most if it was right. And the reason for that is, and I just hope that this is clear, when you short an inverse leveraged ETF, one of the things that you can benefit from is it's very much like an options trade in that there is a decay that occurs, particularly when you've had a high degree of directional volatility, and that just fizzles into a less directional range. The leveraged inverse ETF will drop as you just simply chop sideways. So if the GDX goes sideways for the next month, dust will go down to 35 and below. And that just means that I can benefit from either a reversal and rally in the gold miners or simply a loss of directional volatility. So it just makes it more likely to succeed rather than necessarily more powerful if it does succeed. Hopefully that's clear.
Yes, it is to me, and you've laid out that dynamic in webinars before, so I encourage you could probably find that on the Briefing TV, but if anyone needs to understand how that dynamic works out, you can send us a feedback message and we can probably point you in the right direction. All right. Have we covered pretty much everything as far as gold? I know you've got a longer term target, and we laid this one out that it could take months before this one, and you wouldn't have a problem rolling this over into next year's futures contract if you needed to.
Yes. But I mean, so I'll tell you, the last thing I'll say about it is, look, you're living in one of two universes here. And either you're in the universe where this big consensus bet right now that I described a few minutes ago is correct. If it's an extended period of disinflationary growth that continues to favor the U.S. over the other major economies, and if we roll on like that for the next year or two without there being this kind of, maybe we're assuming too much from that right now, maybe we kind of snap back toward a more median kind of view in terms of the U.S. relative to the rest of the world. Which side of that we're on is going to determine how this works out. It's not impossible that gold will move back into a period like we saw in the late 1990s and in the early 2000s, and we will start to see producers get below their cost of production and stop taking the short side of the bet and start betting on the price going up and no longer pulling gold out of the ground. And, that opens up the possibility that this could get significantly more net short and we see the price deteriorate. If that's the world we're living in, this is going to be wrong. And, that's, I believe, given the degree of shift that we've seen in sentiment, that it is more likely that we're seeing some kind of important low being made here. And if that's true, it's a higher low, which is how you see, I don't know if this reference is going to fly past everybody, but there's something I used to use Elliott wave analysis a reasonable amount, not as kind of a hardcore tool, but I used to appreciate the idea that there was a rhythm to the markets, and I still do. And when you have a recovery from a bear market, I think the longer the time frame, the better when it comes to this kind of thinking. It's not so much about the precise set of steps involved in the construction of an Elliott wave to me, but it is about the kind of logic of the puzzle pieces that make up a recovery. And one of those puzzle pieces is this idea of the wave 2. So wave 1 is the first impulse in the new bull market. Wave 2 is the first correction. Wave 3 is the middle kind of surge where people start to realize, that this direction has changed, and you start to get a little bit more mainstream participation. But that wave 2 is often, it's kind of like it stops short of making a new low. So it is a higher low, but it is often when you get the darkest sentiment. It's like a divergence in an oscillator of sentiment. So you get this period where people are more convinced that the longer-term bear market is going to continue lower, but that sentiment extreme comes into place at a higher low. So if you look at where gold is now, you can see that we made the big low a few years ago, right? There's this low in late 2015 that comes into play, and really what bottoms it is we get past the first Fed hike. We get past that world where the Fed is now hiked, everybody was stacked in short, and we start to see, the money flow back into gold, and it puts in this big bottom from a huge downward move that had played out over the course of, 4 or 5 years. And that bear market may have come to an end there. And what I would expect to kind of show me more that that's the case is a situation like we see right now, where you see even more bearishness, and the first net short in the futures is a good example of that, but it's at a much higher price. We were at about 1,050 per ounce back in late 2015 when we made that low. Now we are up around 1,200, 150 points higher, and we're seeing even darker sentiment as people are looking for this, this to be a continuation of that bear market. But everybody's already crowded into that kind of bet, and we're at a much higher price. So that wave 2 kind of logic is another sort of point that I'm betting on here, that this may be a formation of a kind of low that ends up being before the most important move higher in a new bull market. This is when everybody has really just decided that there's no hope for gold, but we're at a higher price. And when we start to rally and you start to swing back to the other end of that spectrum, you could have a significant price gain. So I wanted to get some kind of exposure on here simply because from a very long-term perspective, there is that logic to how we're flowing. And again, gold is very arbitrary in its pricing and can perform or underperform in any sort of environment. There's no laws with gold. It can be what it needs to be when it's ready to be it. And if we are starting to see a point where everybody's already thrown it overboard, yet we are at a structural point in the long-term pattern that could be the preface before the major move higher that lets everybody know that late 2015 was a significant bottom, then this is a really opportunistic point to at least put something on and see.
That might have been one of the best interpretations of how to look at Elliott wave that I've ever come across, because it's very tricky, and I've tried to study it, and I could always find another case for a different wave developing, or
Yeah,
and keep moving it
sure.
along and keep moving it along.
I don't worry about it.
And
Yeah.
but you highlighted a point where there's something where you can at least paint a picture of this could be developing, and therefore I can identify and pinpoint a place where, okay, there might be a turning point in this wave where this just a point of inflection that may be
Yeah.
developing, and mark this one down as a good go-to for if anyone needs to study more on Elliott wave or needs a little trigger point. There's a good one. So
Well,
I'll
let me
mark
add
this
to
one
that
as that.
actually. Let me add to that just a tiny bit here. So this is Brett's Elliott wave, Brett's wave. I don't know. It's different. Most people that you'll see talk about Elliott wave are very technical in terms of pattern structure. And I spent a lot of time on this a lot of years ago, and I went through a period where I was programming systems, and then I kind of shifted into looking for different ways to generate insights for that. And I got very, very much into just trying to see if I could find an Elliott wave structure underneath things that at least gave me a general guide, and I figured it would be very flawed, but it at least could point me something. And what I found is, where I think it's correct, is that there is a pattern of different personality segments to a market move. There's a personality that you can find at different times that matches a pattern. And I think you do need to go through a process of there needs to be the achievement of this particular personality of the move before you can move on to this next stage of the development of the personality of that move. And it's flowed into what I call the mode of the market. So I kind of formed my own way of looking at this, and I don't get overly technical about pattern structure. I look for a lot of different signals to suggest which part of a move that we're in, which segment of this evolution of personality that we're in. So the personality of this point of gold would be that kind of, the price is performing better than it should given this huge divergence by seeing actually more skepticism than we saw even at the bigger lows. And that's the personality of a wave 2.
Well, that's very good insight. I'm definitely going to start looking at that and paying more attention to that. I appreciate that, so I'm sure the listeners will as well. All right,
Sure.
Let's take a look at another one that you found pretty interesting, and that's the bond market. And I guess we'll look at the 10-year.
Yeah, sure. So, we just have seen this explode into even deeper net short territory. And this doesn't have the sort of problems that we were talking about with gold in terms of there's not a bunch of treasury bills stuck in the ground that somebody owns and has to mine. And, this is a market that represents the heights of speculative fervor right now in terms of the short side thesis. This is by far and away the biggest all-time short position that we have ever seen in treasury futures. And that means, it's this larger bet that we were talking about earlier, that there's a very consensus idea here that interest rates are going higher in the U.S. That's the simple thing, and that really, I think, is a bet. It's not a bet on inflation getting out of control. I just don't think that's a viable thesis. I think it's a bet on there being strengthening cyclical tailwinds. It's the same reason why over the last few months I've come on saying that I believe that the dollar is going to break out again. It's this idea, I think it's pretty much all based on the fact that there's a lack of synchronization between the cycles in the U.S. and the cycles in Europe and Japan, and now China because of the trade war. So if you take Europe, Japan, and China, the three next biggest economies by far, relative to the United States, and they're all at a very different place in their cycle. If you think of like a garden of flowers, right? They're growing up, and you always know a certain point where certain flowers are going to bloom, and then they bloom, and then they wilt, and then new flowers bloom, right? So right now the United States is blooming, and there's just bulbs in Europe and Japan and China, and they're just in very different places in the cycle. Then you pair that up with the fact that we're doing fiscal stimulus. We're doing effective fiscal stimulus. We are pulling future growth forward into the present right now, and that's what the tax reform bill is doing. And it's going to be in its most applied form from basically now until the end of the second quarter of next year, according to research that I've read. So if both of those things are independently putting pressure on the situation, then you're going to see something I talked about in our carry trade piece, where you've got, cheap cost of capital in other areas of the world and relatively higher return on invested capital in the United States. And all of that should be something that pushes the dollar higher and pushes interest rates higher in the U.S., forces the Fed to keep acting, but we've still got enough sort of structural deflationary forces in play that it's not really a bet on a big, blossoming of inflation, but it does keep the Fed active, and it pays off at the long end of the curve, and it pushes the dollar higher, and it's the same reason why you see a net short in gold. It's all kind of one idea that just has a number of different expressions. And right now, probably the most aggressive expression is short treasuries. But just like we've seen a number of people over the last few days kind of highlight the possibility of a squeeze there, because it is crowded. And when ideas get crowded, even if they're right, they're awfully tough to stay with. And there is the possibility of a squeeze in treasuries right now, just like there's a possibility of a squeeze in the yen and gold if people start to feel like they've gotten too crowded, and there starts to be just a couple of little hints that start to come into the picture that cause some doubt on that big thesis.
When you're looking at this one on the commitment of traders chart, are you looking at the same numbers, the large spec, or are you looking at something different?
Absolutely, same one, yeah.
Okay, so the green large spec.
See the green line? Yep. Remember where it was in gold? Barely got to zero?
Yep.
Yeah, if you look, all time for this market, what you're looking at right there is by far and away the furthest to the downside that green line has ever been.
Yep, and I do see that. So if anyone's looking at the chart with me, you can see where that divergence comes in. And commercial spec, what's that?
It's the other side of that market. I mean, you're talking about major dealers.
Okay.
So, people who need to be exposed long the bond market for whatever reason. I mean, that's probably one of the most complicated positions to break down in simple terms. It's not simple like gold, where I can just say, I can tell you the red line is a bunch of people with gold in the ground and mining equipment. You're talking about a financial product here in Wall Street, so I can't so easily tell you what that red line represents, but it's people who need to have some kind of exposure along the bond market.
And the small spec, is it safe to say it's more retail type investors or no?
I think, what it is by definition is just the people who didn't have enough of a position to have to report by the rules. It could be anything, but it's always so small that it's somewhat negligible. Mm-hmm. But yeah, I think of it as people who are trying to find ways to trade, the bond market and with leverage. So, options on TLT are probably a similar thing.
Okay. So you don't currently have a position here. What are you waiting on to see?
So I'm short 30-year Treasury bonds, and
yes,
I've been
I know
short
that one.
Almost all year. Yeah. So this is the 10-year. To me, that's essentially the same position with a little bit more of a, longer duration. But the question is, am I covering because of everything I've just said? And I'm still not. And it's just not a significant position, and it's well in the money. And I just haven't gotten to the point where I'm saying, I'm going to give up. One of the factors that influences this a little bit is, you have to pay money to do this, and I just don't know how much people are going to get rid of these positions. If you have a significant enough size, I do not, where that's a major factor. You got to pay the interest rate, so you're essentially on the other side of the trade with the Treasury, and it doesn't affect a small speculator, but if you have a significant position, then I don't know how likely you're going to cover if your thesis is really simply, because you got to look at what this is about. What's the idea about? And the idea about is, at some point, you're going to see another leg higher in interest rates. And I doubt that it's going to be too easy to get people to believe that the cycle is over, because that's essentially what you're going to have to do. I think to cause mass covering in this market, it's not just going to be about something like Turkey. It's going to need to be about something like the effect of the stimulus has worn off. Interest rates are too high. We're starting to see layoffs. We're starting to see a poor inventory to sales ratio. We're starting to see poor leading indicators, things like that. I think that when people start to get that feeling that this is not just some kind of little macro scare, but we're beginning to see, the beginning of the end of the life cycle of this expansion cycle for the United States economy. And I don't know, if that's going to be on the radar anytime soon. It just doesn't seem to fit with the data, and I think that people are going to be relatively resilient in the wake of little scares. So it may be a situation where you wait for a squeeze and you actually short. But it's still, I look at it more importantly. I think probably I look at it as another example of where assumptions are, and that can cause problems, at least in the short term and maybe the intermediate term, if there's just too many people crowded into the same assumptions. Whether or not they cover treasuries is one thing, but it could affect the dollar, it could affect gold, it could affect equities, just to know that there are so many people lined up on the same side of the bet, if that makes sense.
It does. Do you ever do anything, for instance, would you put on a knob trade, and knob being, for the listeners, the notes over bonds, where you would be long the 10-year and short the 30-year?
Right. Essentially a spread trade along duration.
Yes.
And, you're saying, long 10-year, short 30-year, so really looking for the long end of the curve to steepen.
Right, exactly.
Yeah. I just kind of group the 10 and 30 together because, to me, it's about where the Fed has control, and the Fed doesn't really control that. Anything past about 7 years doesn't seem to be impacted a whole lot. It would actually move inverse to what the Fed is doing if the Fed was making a policy error one way or the other. So wherever you see that, if you get the sense that the Fed should be hiking rates and they're not hiking rates, you're going to see the long end of the curve, the rates explode higher. And if you see the Fed shouldn't be hiking rates, but they are hiking rates, you're going to see the yield curve flatten. So, and that's going to be 10 and 30 together. And differentiating the 10 from the 30 has never really been my cup of tea. And I'm not sure that I would probably, go down that road simply because that seems like that depends upon just a different type of insight than I have.
Okay, and that's fair. I was just curious if you ever dove into that. It would have been one of those cases, in this case, where if you wanted to maybe hedge that position and you were tilting towards maybe a steepener, that might work out for you. But if it's not your cup of tea, then it's really a moot point.
You got to pick your battles. Now, what I do like is you don't see anywhere near as much of a crowded situation in the 30-year. So if you flip to ZB, you'll see that it's nowhere near an all-time high in terms of short interest.
Right.
So that would be another push in your favor that's the place to hedge, actually. Doing exactly what you're talking about.
Right, and that's part of the reason why I asked that question, if it was in your wheelhouse of things to do. And if not, maybe it's an idea for somebody out there who might be motivated to do such a trade. I know every once in a while there's people who will put on those interest rate spread trades like that. So I used to trade those back in the day, if you didn't know.
I didn't, actually. That's very interesting.
I actually started in the Boons and Bobble. Boone, Bobble, and Schatz is where I got my start.
That's very interesting. Your past is full of mysteries, Jim.
Hey, I keep it that way, my man. keep people intrigued, like little cliffhangers here and there.
You got it.
All right, so as for the other commitment of traders' data, was there anything else that really stood out to you where you see some opportunity?
So the dollar was the other kind of point in this trifecta of, paired up insights. The dollar, if you look at where we got to, I don't know if you can easily pull that one up, but that was another one where, it's not an all-time high in net long, but it's a recent explosive move into net long position that rivals some of the biggest positions that we've ever seen going back. And I think the pace of the change is pretty important. I've been kind of talking for the last few months thinking that eventually we would see a bunch of new speculative dollar-based positioning, and we would see the euro break down, and we would start to flirt with net short in the euro, and I think we just got there. And it seems like, this rapidity with which we've exploded to a big dollar net long position is an interesting part of why I really focused on all of this in my notes is, for the larger point of just saying, hey, look at this data, get to know this data, use this data, but also because it's been a very sudden kind of emergence of consensus over the last few weeks, where there's been tentativeness about these ideas, and it seems like suddenly everybody's just decided to just throw in together on this bet essentially being about, this extended and dramatic U.S. disinflationary expansion relative to continued stagnation everywhere else. And I think that that's really what this is. And I think that it is really about the fact that, the Fed's just going to keep on hiking, and the U.S. is going to keep on growing nonetheless. And, we're also doing fiscal stimulus with sub 4% unemployment. And there's just nowhere else in the world that's anything like that. And that disparity, that policy of divergence trade, it's the same thing that we talked about in June that we shorted gold on a while ago. It's the same idea, and it's just starting to blossom into this consensus position now. And wherever the price is, when you start to see consensus, you have to start to look for inflection. That's just kind of the playbook I use. And there's a lot of different things, including the dollar now, that are confirming this idea that we've now kind of built toward essentially a consensus position that this is what's going to be. And there's a lot of different opportunities that come from that, possibly. And there are opportunities that take small size, wide risk, and patience. And one of them is the gold long that we talked about. Another one of them very well may be emerging markets, which I talked about this morning. Mm-hmm. If you've got a consensus betting that there's this high return on invested capital in the United States and nowhere else, and what we do is we borrow money in yen and euros and everything else, and we pour it into U.S. Assets, tech stocks, whatever, real estate, whatever. If there's already a consensus that's built around that, then there's probably a situation where you've got a sustainable global expansion underway and you don't have any speculative capital in emerging market stocks. So that would be the other kind of way to look at the situation. I don't know if late August is going to be the best time to move into a bet like that. But again, we're talking about small size, wide risk, and patience. And this is the sort of environment you look for with an opportunity like that. You know that it's not filled up with speculators, and it is a strong global growth environment. And the two of those things paired together suggest the possibility that there are some opportunities because there's become a kind of unbalanced speculative environment.
All right. So I'm looking at the COT for the dollar, and it's not quite near where the and so I'm assuming that this is getting into overextended longs, perhaps, and so the play would be a short dollar, right?
Well, the question is whether or not it's a short dollar or whether it maybe says dollar upside momentum isn't going to be dramatic from here.
Okay.
And we saw a couple of weeks of sharp dollar upside momentum, and we saw certainly it being difficult to short the dollar a few weeks ago in that range. And if this was going to be a situation where I think you just keep betting on that train to keep rolling down that track to the upside, what I would want to see is the same move that we saw without any emergence of speculative involvement. So you can see how this was just, on the chart that you're showing right now, you can see how the green line was just glued to the zero line for quite some time. Mm-hmm. And before that was the environment after the election, right? In the wake of Donald Trump winning the White House and saying that we were going to do all these sorts of, extremely robust things, and we're going to do protectionism and tax reform and all these other things, people just assumed, well, that has to lead to a situation where the global economy is going to be transformed towards something where money just pours into the United States. And then there were some hiccups. And so we saw the speculation waiting for that idea pushed the dollar up, and you can see this back in late 2016 and early 2017. You can see the green line bubble up, and then things start to roll over, and that rolling over was pretty much all those speculators getting pushed back out as Europe started to play catch-up during that period, and we started to see a policy convergence trade, which nobody really saw coming, and as you can see, people weren't positioned for it. The policy convergence trade petered out, and this summer, when Gavin and I did a series of pieces around the central banks, we kind of noted, hey, it looks like listening to these press conferences, the policy convergence trade is over. And now we're heading into a policy divergence trade. And that's where we started shorting gold and, taking a dollar long bias. And it has taken until, this past week for that to blossom into a consensus as far as I see it. It could get more consensus, but you're not at the beginning of the dollar taking off according to this data. So whether or not this means you short the dollar, the main thing might be you look for things that have suffered because of the dollar making the move that it's made and because of sentiment shifting from being cool on the dollar to hot on the dollar. You look at the things that have been left behind, and they're probably opportunities. And the emerging markets is an example. Probably there are some commodity-based examples. Gold would be another example. These are things that fit in the idea that people have just tossed them overboard because they finally decided, oh no, it's right to be excited about the dollar. And that excitement shows up in this chart. It may not be done, but it's the rhythm of the situation has kind of played out here. And we may start to see the policy convergence trade come back around because a healthy United States economy and the stimulus here may begin to be exported to other places, provided that, the private sector is able to figure out how to do that. This doesn't come down to geopolitics. This doesn't come down to central bank policy. You got to remember the private sector is an efficient set of agents who are all looking to benefit themselves. And, there's smart people, and after a while they figure out how to exploit situations. And there's plenty of them in Europe, Japan, and China. And, when the United States is doing well, we tend to, over time, start to export that growth. And you start to see the convergence trade come back into play. So if we start to see that, then you've probably got a lot of undervalued opportunities that will start to pick up steam.
All right. As far as when you look at the equity markets, do you use the Commitment of Traders report to scan through any type of ideas for E-minis or the NASDAQ futures or anything like that? Do you use the Commitment of Traders?
Not really. And the reason is because the equity markets are the most popular markets for most people in terms of betting. That's the game, and there's a whole bunch of tools to understand sentiment that are out there. And really, for something like gold, there isn't much else besides the CFTC data or currencies. There's a few things, but the best thing is Commitment of Traders for bonds, for gold, for the dollar. But for stocks, we're talking about understanding sentiment, and there's a lot of tools for understanding sentiment that are slightly more refined. And what I see right now for the equities market, I wrote about in my notes this morning. Basically, I was kind of throwing out a signal flare to say bears are going to start giving up on stocks. With the mission accomplished idea that we've gone through a corrective period. We're getting up near the highs again, but we've done so in a grinding, gradual trend, and we have reset sentiment extremely efficiently. We have very neutral readings on everything, but we're back where we were during that blow-off high feeling thing that happened in January. We've clawed our way back there, and we've gotten back there with fund managers, according to the fund manager survey put out by Bank of America Merrill Lynch. We're seeing 5% cash in their hands right now, and that's a large amount of cash, and we're back at the highs. And the earnings growth story is only accelerated. So it's awfully tough to make a sustained bearish argument here unless you're looking for a particular macro threat to start to really step on the gas pedal. And it looks like the macro threats that are out there, if anything, are starting to recede a little bit. So it's hard to see how we aren't set up to continue to push higher until we eventually blossom in a new kind of sentiment extreme, which I would find to be more easily signaled by measures other than the Commitment of Traders report for equities.
All right. So with that said, based on what I'm hearing from you, there doesn't seem to be a whole lot of opportunity, at least yet, in the equity space as far as the vehicles that you like to use, such as the E-mini futures, E-mini NASDAQs.
Well, I'm long the stock market. I've kind of made this note a couple of times probably 6 or 7 times over the last 2 years that in late 2016, I kind of took a bunch of my capital and I gave it to somebody else. And I said, I'm going to trade this portion of my capital and you're going to be in charge of this other portion of my capital. And I know basically it's long only, and it is diversified into U.S. large caps, U.S. small caps, and Europe and Asia and Far East mid caps, as well as investment grade bonds and high yield bonds in an even distribution. And it is pretty much long only fund to funds top down exposure, and it allows me to survive really low VIX environments where I can take the rest of my capital and occasionally pot shot short and look for, worst case scenario, very small losses or scratches, but I end up making money if the market goes down because when I'm doing that, I'm using a leveraged futures position rather than an unlevered, simplistic long-only strategy in the hands of somebody who's just doing basic standard metrics. And that is, I think it's, if you want to find peace as a trader during a period where the VIX is consistently at 10 or 11, and you feel like everything lines up to suggest that, that environment is one that can be broken occasionally by overexuberance leading to resetting, but otherwise you don't want to sweat it the rest of the days when you've got something like a late August market moving higher on low volume with a VIX at 10 or 11. It's a good system until we start to see periods where there is more aggressive volatility and in equities as far as trading opportunities. It just kind of, it gives me a peace of mind.
So that sounds like a no to my question.
I mean, there may be opportunities to look for volatility to erupt here and there, and one of the things that I think could inspire that probably to some extent is if we start to see some of this big consensus bet that I'm talking about start to walk backwards a few steps here and there. If we start to see treasuries and the yen and gold move higher together, that's kind of a macro red flag for people, and we could start to see volatility tick up in an environment like that. And I actually don't believe that, and I may shift away from this strategy before too long, simply because I'm starting to get the sense that we may have put in the lows for the VIX for the cycle. And if you look back to previous cycles, it's typical that the VIX will not make its lowest lows when the market is making its highest highs. If you look at the VIX bottom that we had in the late 1990s, it was 2 or 3 years before the top, and we started to see higher VIX levels come in and be standard during the final blow-off period. Same thing happened in 2007, 2008. The VIX tends to put in a lowest low maybe a year and a half to 2 years before the end of the larger cycle, and you start to get maybe a very late stage, more interesting trading environment from a top-down basis, and eventually a turn. And if we can put this all together with looking at when the effective period of the tax stimulus is, maybe by the end of second quarter of next year, you've got the makings for a pretty interesting period starting up this fall, especially if we see some of this consensus bet pullback, and we see that it is in fact a higher low in the VIX in place, and we get a more consistent sense of a 14 to 17 kind of VIX that starts to come into play. That I think that, this is going to be a more aggressive trading environment that starts to come into play. But as far as, and by the way, the euro is starting to shoot higher here. I don't know if we've noted that, but that is obviously in line with some of this idea of it being, the dollar being overly crowded on the long side, but I don't know if we've just had headlines. Do you see the euro?
I didn't.
Hey, bro, I've been keeping an eye on that euro. There wasn't anything in particular that, we could go off of the Kaplan headlines, but he was pretty much steady as she goes, and he's not a voter. He's pushing for 3 to 4 rate hikes to get us back to neutral before we reassessed where it was going. So certainly setting up a little bit of the battle between the president and the Fed, as we've talked about in the past. But this euro move here, it's been more momentum. There wasn't any additional headlines that were making the rounds here.
So, I think it falls in line with if everybody's betting on the dollar going higher, and that was a crowded bet, as we start to come back, because we just came back above the late May lows right here and the early to mid-June lows in that pattern. So we've essentially taken back all of that breakdown now.
Yeah, one of the ways that I was assessing this recent move, Brett, was just basically some of the fringe players that were probably getting into that overcrowded trade that you've been talking about late and getting shaken out a little bit on, the president's comments, I suppose. But real quick, what would you be looking at as the canary in the coal mine for this string to kind of get pulled to unwind this massive trade?
This technical. It just, if it feeds on itself, right? If everybody's in a crowded trade, the most important thing is that it just feeds on itself. If it just starts to happen, that people start to, pull back, then if, it's like a cascade, I think, when the people who are most over-levered and most tight with risk and most nervous start to kill their positions off, then, you can line everybody up like a dominoes line in terms of those factors. How over-levered are you? How much can you afford to lose the money you have in play? How nervous are you? You get to from one end of that spectrum to the other, and it just cascades as the move becomes bigger. So it should just be able to trigger on a strictly technical basis if people, if people were just pushing it to where it shouldn't be because they, sentiment was flowing such, unidirectionally.
Okay, yeah, no, that works for me. That's kind of what I've been watching. I know I've certainly been paying close attention to this. The Euro move's killing me as I'm getting ready for my trip out to France there. I was really hoping that this would stay down, so anything you can do to help that out, Brett, would be much appreciated on my end.
Yeah, I'll make some phone calls. Don't worry about it.
How do you discount, I'd appreciate that, but how do you discount the move in this market? Or do you think that matters?
What's that?
It's late August market. We know European participation is always low around this time. Certainly, the U.S. participation has been dying off. But again, I suppose that they're not waiting around, and the exchange rates aren't waiting around for people to get back to the desk. But I still view this as more of some fringe people being shaken out rather than the beginning of a major wave wiping out this entire trading theme that's been in place for a while. Do you view the timing of this late August as any difference maker?
I get what you're saying. I'm not sure whether or not that plays a whole lot into. I could see being during periods like this, the move is not as meaningful, essentially, because when they're the more significant decision makers, do they end up making the same decisions they were making before they went on vacation?
Right. And I kind of go back to August in 2015 when we had the yuan devaluation, and sure, it caused that brief period of volatility, but it was basically a V-shaped bounce in a lot of the asset classes around that time. So
it's interesting that you bring that up too, because that was one of the most insanely crazy shifts in sentiment right there that I can remember seeing in terms of data I watched, from very middling to something that was such an extreme in bearishness. Everybody just thought that the market was just done forever, and there was no way we couldn't get that type of V-shaped bounce to see that type of sentiment. Now, but yeah, I mean, I understand your larger point. But the question is, both the dip and the rally are happening during this August period. So maybe we're just maybe it's the insignificant players that caused the euro to drop, and now we are back in the range that we've been in since late May.
Right, because I know you are one that is loath to trade off headlines, and we could certainly point to the president's commentary as at least on the surface appearing to rattle the markets a little bit. So that's kind of why I'm just I'm following this move like you are. But given the headline and the timing of this move and the participation, I'm just curious, what would be some things that would really have you thinking that this isn't just some fringe players getting shaken out, and that this move is certainly on the march, just pure technicals, looking at the euro breaking back above towards that 116 level perhaps? Or
I give you the most unsatisfying answer anybody could ever give, and that is, if it goes back down a bunch, then I'll agree with you.
Fair enough.
I mean, I'm not going to short it right now, given that we've already got such the consensus bet that I've been talking about. It makes it tough for me to play that side of these moves at this point.
Okay. Just as a heads up too, along those headline risks, Trump's going to be interviewed by Fox tomorrow morning at 6 a.m. Eastern time, it appears. So just want to make people aware of that.
Right.
All right, Brett, as far as any additional new trades that you may have up your sleeve, do you have any?
Let's see. So I am long gold back to close to the break-even area, short the dust, which is long the gold miners. I have an established, as I said, unlevered position along the stock market, which I will occasionally look to pot shot on the short side while we see this type of environment. The other possible ideas would be, so crude oil, we talked about this a couple weeks ago. As I basically said I thought we were going to go test the late May, early June lows as the formation of a range trade rather than to move out of the trending environment. So we actually accomplished that last week, I believe. We moved right down and tapped the 200-day simple moving average, which is basically right at the level that formed support at 64.50 in early June. So we have formed what could be the bottom of that range. So now my perspective there would shift back to possible long side. Tomorrow, off of the data, if the data is headline bad and we start to knee-jerk down, that would be a possible long trade. We still have a situation where we've got a pretty sizable speculator long position established there, so it's not probably an aggressive opportunity. But we did get to the downside target in what I believe will be a fluctuating range. And so if we get an offset imbalance in terms of trading orders, in immediate reaction to the data tomorrow, then that would probably offer up some kind of long opportunity in oil. Otherwise, if we get an unwinding of the trade that we've been talking about, so there's the emerging markets possibility of a long, and there is maybe the possibility of a yen long as a way to play the dollar coming back in, simply because that's probably the funding currency that's been driving things. So, and always probably on the radar would be very directly headline-inspired shakeouts in the equities market as long-side futures trades. So that's, I think, the mode we're in right now, is seeing the occasional headline-inspired sharp shakeout as we start to get people, moving money back in there and getting spooked back out. I think you're just going to see a number of opportunities like that, where you get something that's an immediate headline catalyst, it shakes the market out back down through its morning lows, and then we start to see a big comeback in, and we gradually grind back higher. And you just need to take those trades with relatively small size, enough risk to be able to weather that sort of fever while it's on, and then just kind of be patient with it as it walks back higher. We've done that a number of times in May and June, and that's the same kind of process that I think could be in place here, as well as some of the trades that we put on back in November and December.
Well, it sure seems that we have the potential for some headline risk. So I definitely encourage the listeners to go back. If you didn't catch this one or you need a refresher, go back and get some of these on the radar, the euro, the maybe something in oil, and maybe even look at maybe positioning in case we get a headline-driven sell-off or whatever in the equities, in the futures, and maybe there's some opportunity. I always like to give listeners heads up as preparation, because you never know. These trades pop up out of nowhere, and you never know when that next headline's going to come. So I appreciate you handicapping that for us, Brett.
Sure. Thanks a lot, Jim.
All right. Well, maybe we'll have you on later on this week, maybe tomorrow if a oil trade sets up, because we have the EIA data. But as always, it's been very educational. Thank you so much.
Thanks, Jim.
All right.
Okay.
So that was Brett Manning, chart trader, breaking down what he sees in the market. Hopefully you guys were able to follow along on the visual, and if not, a lot of the charts that we were looking at come from barchart.com, and if you just Google barchart.com and type in commitment of traders, you can find a lot of the charts that chart trader was that he brought up, and we can begin to formulate and structure some ideas the same way that he does. So hopefully that is helpful. It's good to do some homework on your own, and helps you get some context as to what he's talking about if you're unfamiliar with that commitment of traders data. Obviously it's very influential and instrumental to his trading strategy.